Happy spring to you all. This is Bret Mason, one of the managing partners of the Brechnitz Group. Welcome you to the Brechnitz Group brief on market volatility. On behalf of the entire team of Wally Sparks, Greg Huck, Beth Nolan, Jim Neff, Rich Kaczynski, and Mark Huss, and of course our amazing staff, Shauna Wagers, Brooke Connor, Jody Ferguson, and Brenda Seberg, we welcome you to this edition. Before we jump in, there are some important disclosures. The past does not predict the future, and your investments are not guaranteed, and the opinions shared here are ours and subject to change. Well, market volatility has arrived. We're seeing this the last several months. The markets are now down about 11.75% from the peak. The decline of nearly 20% in the NASDAQ and Magnificent Seven, which are, of course, the kind of the darlings of Wall Street the last 2 years, including the AI stocks, were down over 28% from the peak. The news outlets are focusing on this, and of course, their job is to sell advertising and sensationalism, so you're going to get a lot of panic and discussions about this. I guess what we want to do is talk about how market volatility is part of a market cycle. This next page shows you that same drop in a broader 5-year relationship versus a 1-year. This slide, if you look at it, you see such a short-term focus on the downturn in relationship to only a year. You take that in terms of a longer term, you see that the S&P 500, which if I were to ask a quiz of any of you how much you thought the return was on the S&P 500 the last 5 years, including this drop, and you'd be amazed to hear it's 18% a year the last 5 years. Year to date, the S&P is down 8%. The Dow Jones Industrial Average is down 4.7%, and NASDAQ Composite is down 14%. So again, these are real losses, and they're definitely are painful. This is part of the market cycle, and it happens. We've been talking about as a team that markets had gotten a little bit ahead of themselves. We had, of course, the Magnificent Seven we just discussed, were such an outsized portion of the entire market, and they're representing almost 40% of the total of just 7 stocks. So we had those very few driving things, somewhat reminiscent of the tech bubble back in the late 90s. The difference was these stocks actually do have earnings, and we're making money. But they did get to be a very large portion of the whole market, as well as they were causing the market to swell to where the S&P 500 and the broad indexes had valuations, meaning how they traded in relation to the earnings. They were approaching 30, 40, and sometimes 50% of normal average valuation. And so at some point, we have to have what we call a reversion to the mean. So reversion to the mean is just a big fancy Wall Street term that means bringing things back to the normal averages. That's what's happening, and that's what causes the markets to adjust back and why we have these corrections. The next slide we'll show here is showing you the fact that corrections occur on average. A 10% correction occurs about every 18 months on average. We have not had a correction since 2022, so we're about a year and a half overdue. A 5% correction generally happens about every year. So again, we've had very little in the terms of corrections. This is a great chart because it shows you each year what the market's worst point was during the year. The red dots show you the worst point in a year. So you can look at a big year down like 2008 when we had the Great Recession. We were down 49% at the worst. We ended up trimming some of that loss by the close to be down 38% by the end of the year. And in the next 2 years, we're up 23 and 13%. I think it's very interesting to note 2020, where we had COVID shut down the entire economy. If you remember back, we had the entire economy shut down. You couldn't go anywhere. You had to stay in your houses and be masked up. That market dropped 34% very, very quickly. We had 3 or 4 days in a row where we dropped 7 or 8% every single day. It looked like the sky was falling. Interestingly, that same year, we opened back up the economy, things got better, and we ended up 16% positive for the year from a 34% negative starting point. So these kind of downturns are not unusual. So when you get on the news media, you hear people talking about how horrible this is part of the market cycle. And we as a team have been talking about that we are probably overdue for a correction, and it's going to happen. The next slide is probably the most important slide right now that we're hearing about on a constant news cycle. And that is all these policies are being introduced in what I'm calling in a shock and awe fashion. What I mean by shock and awe is President Trump's administration has come in what they believe is a mandate of what they were elected to do. Now, I have clients and friends, and I remain friends with people on both sides of the political spectrum. So I'm going to try to stay non-political and very facts-based on what research is telling us and on what we're hearing from different analysts on what's going on here. This chart I put together, or this slide, is showing you the marionette, if you will, in the middle, which is the economy being pulled in all different directions by all of these different conflicting, sometimes, policies we're trying to enact at once. Now, to take a step back, why are they doing so many things at once? We live in a political environment that is not like it was in the 80s, where we had a Ronald Reagan could work with some of the Speaker of the House back then and they'd get along, or some of the other periods. We have a period where there's constant fighting, there's very little cooperation, which is sad, but that's the time frame we live in. I think that President Trump's administration feels they have about a 2-year window that they've got to get some of this done, and really probably a 6-month window to put it all in place into this shock and awe that I'm talking about. Because think about it, if this much turmoil is going on in 2 years when we have midterm elections, and if they were to lose the House or the Senate, any progress on this mandate or this agenda would cease immediately. So what's going on is they're trying to hit a lot of things at once and do it very, very rapidly with maybe a sledgehammer mentality, which is painful. The very first one we're hearing the most about are tariffs. Tariffs, on the surface, Economics 101 will tell you that tariffs are inflationary. They add cost to the consumer. Tariffs make the economy have a tougher time overcoming these, and they're an extra tax. But what's going on here is that we have had unfair trade practices going on for 30 to 40 years. I had a chart that I would love to include it, but I didn't want to go back and get compliance approval, but it shows tariffs around the world. Our average tariff is about 3% of goods coming to us. Our average tariffs with our biggest 10 trading partners is anywhere from 17% for some countries in teens, and that's just the top 10 trading partners. Some of the trading partners that are more lesser developed countries add on tariffs of sometimes 30 and 40%. So that means that when we're trying to sell goods overseas, they're adding that on to fund a lot of their government programs by adding those costs on. And we're adding on an average of 3%. Now, it doesn't make it right. It doesn't make it any less painful. And I have used the analogy, it's kind of like an abusive relationship that you hear about where there's been abuse going on for years, but the person will not get out of the abuse because they find it too painful to take the steps to leave that relationship. I kind of look at this as the same. We can continue on kicking this can down the road, but if we're really going to address the trade policies that have caused us to have a $80 billion a year trade deficit to other countries, there's going to have to be some very big and painful things done. And so that's what they're trying to do. Now, I'm hoping and praying that some of these tariffs will be cut back and negotiated down, and that's the goal. Our goal is not to just have large tariffs and make it where consumers pay more. The goal is to have it to where we get more reciprocal or fair trading with countries and bring back maybe the 30 years of unfair practices we've had. Now, one side note, the last 30 years, globalism of all those products coming in very cheaply have been a very good help to the consumer, because that's how we've gotten a standard of living that has been maintained. When you have, if you remember back, large screen or flat screen TVs are $4,000 or $5,000. Now you walk down the aisle and they're $400 or $500. That's globalism. That's bringing in cheap goods. But we should be able to take our goods to those countries as well, and that's the goal. So that's tariffs. I'm going to run through some of these other ones. The tax cuts. The big, beautiful bill they keep talking about, and we're looking at the 2017 Tax and Jobs Act that we are trying to get extended because it will expire at the end of this year if we don't, should get extended. That's something, if that does not happen, would be very negative, but that's something else we'll be watching. Drill, baby, drill. You've heard that term used, saying get back our oil industry back here, get to where we're not importing as much oil, and back to energy independence, which we were about 4 or 5 years ago. So that's the goal, is to get us back to energy independence. And this is all tied together, because think about if we start doing more drilling, more pipelines, that's metal and steel, that's all back to the tariffs of imported steel. So we're trying to get those things fair all the way around the world. This big one here at the bottom is something that a lot of people kind of overlook. We have a $36 trillion debt. So that is huge, and it is a very, very costly and one of the largest overhanging clouds of our country right now. We've overspent. We've not been prudent for many, many years, and now this debt level is just going to choke us out to the point in the next many, many years This is unsustainable. We've got to bend this curve of debt. Now, a little thing that many don't know about, 20% of our debt comes due this year. So that means if you're refinancing that much money, think about refinancing your house. What do you want interest rates to do? You want them down. Well, interest rates have been at 40-year highs for some time over the last several years, and we're trying to get that down. It's been very sticky coming down. I believe that one of the goals of this very negative near-term news cycle of the Trump administration, their goal is to make the economy slow enough to where the interest rates will come down, which is what happens when economy is slow, and they can refinance some of this debt at much lower levels. Instead of 5 or 6%, 3.5%. That would be a huge savings to our country over the long run, and I think that is one of the goals. So we'll watch this. It's a very, very dangerous, high-stakes game of chicken. And I use another analogy. It's kind of like trying to take a patient in the hospital and slow down their heart rate almost into a coma state without killing them. So we don't want to go in recession. That's the dangerous game we're playing, is slow down the economy so the interest rates slow. We want inflation to slow, which has been a real problem the last 4 years. And that's what I think they're trying to do. But it's very dangerous and very high stakes doing this. Another one of the goals is removing some of the regulation that's been overbearing to some of our companies. We have more regulation out there than any other country by far, and that's one of the goals. And finally, DOGE, which is something we should all be rooting for, cuts, right-sizing our government. Now, how they're doing it, that's another question. A lot of people are very upset about how they're doing it and what they're cutting, and are they taking a chainsaw to something that should be more precision? I don't know that answer, but I know that we've had a big, big problem for many, many years, and everything from these pet projects that are being funded to waste that's being given out, and we're giving more and more money to our foreign aid than we are to our own citizens, and I think that needs to be right-sized, but it's going to be painful again. So in summary, this slide is maybe the most important. Markets do not like uncertainty, and this is definitely uncertainty. We have a lot of conflicting things at the same time, and I feel like that this shock and awe approach is what's causing the market a lot of disruption, and that will continue until we get some clarity on some of these things. We believe that the economy will not go into recession. We believe that getting this market back down to more normal valuations is a very good thing, and that's a healthy thing. So I think there will be some good buying opportunities, and I think that the markets will hopefully get back on their feet later in this year after some of these things start kind of taking hold and seasoning. But that's going to be interesting and what we want to watch. So with that, I'm going to close up. Thank you again for joining us for the 25th episode of the Brechnitz Group Brief. We value our relationships with you very much. Please talk to your independent advisor and relationship that you work with and make sure that your portfolio is in line with your risk and your goals. One of the biggest things that we talk about a lot is diversification in style and in portfolio construction to make sure that you have the appropriate risk. Diversification, quite frankly, has been unpopular the last 2 or 3 years when you have a vertical market because everyone wants to chase the high-flying tech stocks, and we don't do that. So sometimes our reviews are more frustrating during the straight-up vertical times because we're telling our relationships we shouldn't do that. We want to stay within what our risk tolerance is. These times of the market correct, all of a sudden we look smart again. So it's kind of like when you're raising kids and you're not very smart in your teen years, and all of a sudden they get to be adults and you're smart again. We actually have more gain in our clients and assets when people come in to us and say, hey, I've been referred to you because this client or friend told me that you guys didn't take as many beatings, or maybe you weren't half as dumb as the rest of the market was. But we try to stay disciplined to make sure you meet your goals. So as always, reach out to your advisor with any questions. God bless you and your families, and you have an amazing day. God bless.